just wanted to start with were you supportive of that shift from 50 to 75, President Barkin?
Oh, I was definitely supportive. I mean, we are in a situation where inflation is high, it's broad-based, it's persistent, and rates are still well below normal. And so I think the spirit is you want to get back to where you want to go as fast as you can without breaking anything. And I think it felt to me that after the CPI, after the Michigan sentiment, forward projections of inflation came through, that it was possible to do 75. And I think Jay said this in the press conference, but if it's possible to do it, why wouldn't you do it?
Mm-hmm. So since the market had moved on the data, it was sort of an opportunity to go ahead and take that space that the market was giving you.
Yeah, and I think the data had moved too. It was the market reaction, but it was also just that, that it was quite a pronounced increase in inflation last month. And so it just felt like it was timely to do a little more.
All right. Okay. And so we've gone from 25 to 50 to 75 basis points in terms of the cadence of rate hikes over the last three meetings. And especially given kind of that late pivot to 75, how should we, the external observers, be thinking about what's going to determine the pace of rate hikes from here? What are you, for example, what are you looking at between now and the July meeting to determine what the appropriate size of the next step in interest rates is?
Well, I'm very focused, as I'm sure you are, on watching what's happening on the inflation side, both actual and expectations as best as they can be measured. I'm also watching whatever signals we can take on the demand side in terms of whether the economy is slowing, and if so, how quickly. I'll leave to Jay the question of what guidance to give for the next meeting. I didn't have a problem with what he said at the press conference. Overall, what I'm trying personally to get to is positive forward-looking real rates across the curve. And, we're there at the 5 and up. We're not there at the short end of the curve. I like thinking about it that way because it acknowledges that you have to be flexible in these kind of situations for what happens to forward-looking inflation expectations. Right. And right now, they're still well in excess of where we are today. If you look, for example, at the 2-year forward tips versus the 2-year forward treasuries. But as we increase rates, I presume they'll come closer into balance. And if they do, that might give you a signal on when to start to slow. And if they don't, that gives you a signal that you need to keep going.